In March 2020, something quietly devastating happened to thousands of Indians. People across the country, many of them retirees, lost their life savings in what should have been a simple investment. Not in stocks, not in crypto, but in something that their trusted bank recommended: AT1 bonds of Yes Bank. Here is how it played out. Customers walked into branches to renew their fixed deposits, but instead of the usual low risk FD, they were pitched a better option, something with higher returns and bank backing. It sounded safe, and they were told that this was a smarter way to invest. What they were not told was that these bonds came with a clause that allowed the bank to write them off completely in times of stress. And when Yes Bank got into trouble, that is exactly what happened. According to a report in the Economic Times dated 7th March 2020, over 8,400 crore worth of these bonds were sold to more than 29,000 retail investors. Most had no idea what they were buying. The Reserve Bank stepped in to protect depositors, but the AT1 bondholders, they got wiped out. One investor was quoted in Mint saying that the RM told me it's like a fixed deposit with better returns. I had no idea that it could be written off. Another, whose father lost 90 lakh rupees, said in an interview that there was no risk disclosure, just a pushy pitch. Now let's pause and reflect. This did not happen because the investors were careless. It happened because someone they trusted sold them something that they did not understand. And that someone, the relationship manager, had targets, sales incentives, and internal pressure. This is called misselling, and it is not a one off event. It's a pattern across banks, across insurance, and across mutual funds. And today, let's talk about what the pattern looks like, how it affects you, and what you can do to avoid becoming the next victim. But first, a quick heads up. If you've ever felt confused about your financial journey, where to start, what to invest in, what to prioritize, I have built a free, simple tool that can help. It is not another app, it's not trying to sell you anything, and here's how it works. You begin by selecting one of your financial goals like buying a house, saving for a wedding, building an emergency fund, or planning for retirement. Then, over the next 5 steps, the app asks you simple, intuitive questions without any jargons that helps you fine tune your financial plan. Each step builds on the last, so the advice that you get is based on your context and not some generic tip. And at the end, you get a personalized step by step roadmap that tells you exactly what to do next, whether that is fixing your saving habit, rethinking insurance, or choosing the right investment path. It takes 2 minutes, no jargon, no sales pitch, just clarity. You will find the link in the description below. Try it out and let me know what you think in the comments. And while you're at it, if you like content that actually empowers you to take control of your money, hit that subscribe button and turn on notifications. We talk about finance here, but in your language, not the bank's. Now let's go back to misselling. You see, misselling does not just feel like a scam. It feels like trust. It comes wrapped in familiarity. Your neighborhood insurance agent, your bank's relationship manager, your family's mutual fund guy. But behind that smile is a spreadsheet, a quota, a commission structure. So let's start with mutual funds. Now, mutual funds in theory are one of the best financial innovations for retail investors. They let you diversify, automate, and grow your wealth. But the problem begins when they are sold and not advised. Most investors in India buy what are called a regular plan. It looks normal, you don't pay a fee, but what you don't see is that a percentage of your investment goes to the distributor every month. That is called a trail commission. Now, what kind of funds do you think they will recommend? The ones with highest commissions, which usually means funds with higher expense ratios, maybe even more volatile strategies. And every time you switch funds, guess what? Another fresh commission. Back in 2019, SEBI had flagged this very issue: how some distributors were churning portfolios, encouraging clients to jump between schemes not for better returns but to boost their own payouts. And when SEBI introduced direct plans to allow investors to bypass commissions and invest directly, guess who did not tell you about it? Then come the banks. RMs are trained to build a rapport, to talk to you about your child's education, your recent vacation, even how the market is doing. But beneath all that conversation, their monthly review is also pending. They have to sell insurance, they have to hit mutual fund targets, and they have to push that latest structured note that the bank's treasury wants to offload. This is not a conjecture. In the Yes Bank 81 case, several banks were reportedly offering internal commissions of 1 to 1.5% to relationship managers for pushing these bonds to retail clients. Now let that sink in. On a 50 lakh rupees investment, that is 75,000 rupees in the RM's pocket. And that's why they said that it's better than FD, not because it was safe, but because they got paid more. And when the bond was written off, the bank shrugged and said, we didn't force anyone. Now, it is financial gaslighting, plain and simple. Finally, we have insurance, one of the most critical yet most missold financial products in India. Now, don't get me wrong, if you have dependents, term insurance is essential. If you want to protect yourself from medical emergencies, health insurance is non negotiable. But what is being pushed aggressively are endowment plans, money back policies, guaranteed return schemes, all wrapped in confusing language and long term commitment. Why? Because these plans pay agents big commissions, in many cases 30 to 35% of your first year premium. So if you buy a 1 lakh per year policy, the agent could earn 30,000 rupees immediately. But you are locked in for 15, 20 or even 25 years with low returns, poor liquidity and zero understanding of what you are actually buying. Ask around. Most people you know have bought insurance that they don't understand. Some even think that their investment portfolio is complete because they have 4 or 5 LIC policies. That is not financial planning, that is financial sedation. So, what is the alternative? That is where registered investment advisors or RIAs come in. An RIA is not paid by a fund house or an insurance company or a bank. They are paid by you, the client. That's it. They don't sell products, they give advice. They are bound by fiduciary duty, which means that they are legally required to act in your best interest. They must register with SEBI, clear exams, and follow compliance protocols as well as disclose any conflicts. In short, they are here to represent you, not the financial industry. Now, I know what you're thinking. How do I find a good RIA? Or maybe I'm not ready to pay for financial advice just yet. And that's okay. That is exactly why I created the free tool that I mentioned earlier. It gives you a starting point, a clean, context aware plan based on your inputs, not someone else's targets. And if you do want to go deeper later on, the tool will help you connect to a verified SEBI-registered advisor. It is 100% free, it is fast, and most importantly, it is unbiased. The link is right below. Try it out. And if you find it useful, consider sharing it with a friend or family member who's tired of being pitched to. Because in this country, we don't need more salespeople in finance. We need more truth tellers. And it starts with asking one simple question. Are you advising me or are you selling to me? Now, if you found this video helpful, hit like, share it with someone you care about, and don't forget to subscribe to the channel. This is where we talk about money honestly.